The Capital Asset Pricing Model, CAPM, rests on a handful of clear-cut assumptions that turn a messy real world into a tidy theoretical playground. Investors are rational and risk-averse. They prefer more money to less and will never pick a gamble that offers a lower expected return for the same risk. Markets are perfectly competitive. No single investor can affect prices, and everyone has the same information, homogeneous expectations. Trading is frictionless. No taxes, transaction costs, or limits on borrowing or lending. There exists a risk-free asset that can be borrowed or lent in unlimited amounts at a known rate R sub F. All assets are infinitely divisible and can be bought in any fraction. This lets us build any portfolio we want. Investors plan for a single, one-period horizon. They only care about today's wealth versus wealth tomorrow. The market portfolio is the weighted sum of all risky assets, stocks, bonds, real estate, etc., and is itself mean variance efficient. These assumptions let us treat risk as a single number, the variance or standard deviation of returns, and to show that the only relevant risk for an individual security is how it moves with the market portfolio. The CAPM therefore provides a clean bridge between the abstract world of modern portfolio theory and the everyday practice of estimating a stock's expected return. The security market line, SML, is simply the graphical version of the CAPM equation. E of Ri equals Rf plus beta I times open parenthesis, E of Rm minus Rf close parenthesis. Where E of Ri is the expected return on asset I, Rf is the risk-free rate, beta I measures the asset's systematic risk, and E of Rm minus Rf is the market risk premium. If we plot expected return on the vertical axis and beta on the horizontal axis, every correctly priced asset should fall on the straight line that starts at 0, Rf, and has a slope equal to the market risk premium. This line is the SML. Interpretation. Any point above the SML indicates an underpriced asset. It offers more return than its systematic risk justifies, positive alpha. Any point below the SML signals an overpriced asset. Investors are being compensated too little for the risk they bear, negative alpha. The SML works for any asset, stocks, bonds, projects, as long as its risk can be expressed as a beta relative to the market portfolio. Beta tells us how strongly an asset's return jigsaws with the market's return. Economic meaning. A beta of 1.2 means the asset tends to move 12% for every 10% move of the market. It is 20% more volatile than the market on the systematic side. A beta of 0.8 moves only 8% for a 10% market move. It is less risky. A negative beta would move in the opposite direction. Think of gold or certain hedging instruments. Mathematical definition, covariance variance method. Beta I equals the covariance of Ri, Rm divided by the variance of Rm. Where the covariance of Ri, Rm is the covariance between the asset's return and the market return, and the variance of Rm is the variance of the market return. Numerical example, suppose we have 3 months of data in percent. Asset returns Ri, 12, 10, 8. Market returns Rm, 10, 9, 7. First compute the average returns. R bar I equals open parenthesis 12 plus 10 plus 8 close parenthesis divided by 3 equals 10%. R bar M equals open parenthesis 10 plus 9 plus 7 close parenthesis divided by 3 equals 8.67%. Next, find deviations and products. Table columns are month, Ri minus R bar I, Rm minus R bar M, product of deviations, square of market deviation. Row 1, 2, 1.33, 2.66, 1.77. Row 2, 0, 0.33, 0, 0.11. Row 3, minus 2, minus 1.67, 3.34, 2.78. Sum the last two columns and divide by n minus 1 equals 2. Sample covariance variance. Covariance of Ri, Rm equals open parenthesis 2.66 plus 0 plus 3.34 close parenthesis divided by 2 equals 3.00% squared. Variance of Rm equals open parenthesis 1.77 plus 0.1, 1 plus 2.78 close parenthesis, divided by 2 equals 2.33% squared. Finally, Beta I equals 3.00 divided by 2.33 approximately equals 1.29. So the asset is about 29% more volatile than the market on the systematic side. To estimate an asset's expected return with CAPM, follow these steps. 1. Gather inputs. Risk-free rate RF, for example Treasury bill rate. Expected market return E of RM, often the historical equity market premium. Assets beta I, computed as shown above or taken from a data provider. 2. Compute the market risk premium, MRP equals E of RM minus RF. 3. Apply CAPM, E of RI equals RF plus beta I times MRP. Step-by-step example. RF equals 3%, current 3-month T-bill. E of RM equals 9%, long-run U.S. equity premium. Beta Tech Co equals 1.5 from regression. Market risk premium equals 9% minus 3% equals 6%. Expected return equals 3% plus 1.5 times 6% equals 3% plus 9% equals 12%. Thus, investors should demand about 12% return to hold TechCo's equity, given its systematic risk. When a firm evaluates a new project, the cost of equity is the return shareholders require for the additional risk the project adds to the firm's overall risk profile. CAPM is the most common way to compute this cost. The formula is identical to the asset version, but the beta now reflects the project's exposure to market risk. K sub E equals RF plus beta sub proj times open parenthesis expected RM minus RF close parenthesis. Applied example, a manufacturing firm wants to launch a green energy line. After a detailed cash flow analysis, the CFO estimates the project's beta sub proj equals 0.9, slightly less risky than the overall firm because of stable contracts. The current market conditions are RF equals 2.5%, expected RM equals 8%. Market risk premium equals 5.5%. Cost of equity equals 2.5% plus 0.9 times 5.5% equals 2.5% plus 4.95% equals 7.45%. The firm would discount the project's expected cash flows at 7.45% when performing a net present value analysis. Why it matters? If the project's internal rate of return IRR exceeds 7.45%, the project adds value. Otherwise, it should be rejected. CAPM not only gives an expected return, it also provides a basis for performance measurement. Two widely used metrics are alpha, and Jensen's measure. Alpha, the raw excess return of a portfolio over what CAPM predicts. Alpha equals RP minus the sum of RF and beta P times the difference between RM and RF. Positive alpha means the manager added value after adjusting for risk. Jensen's measure, also called Jensen's alpha, is essentially the same expression, but expressed in the same units as the portfolio's return. It is often reported as an annualized percentage. Performance attribution example. Portfolio annual return RP equals 14%. Risk-free rate RF equals 3%. Market return RM equals 9%. Portfolio beta P equals 1.2. CAPM expected return equals 3% plus 1.2 times the difference of 9% minus 3%, which equals 3% plus 7.2%, which equals 10.2%. Alpha equals 14% minus 10.2%, which equals 3.8%. Thus, the manager generated 3.8% of abnormal return. This is the figure used in compensation and ranking. Alpha can be broken into selection, stock picking, and timing components via regression techniques, helping firms understand why the excess return occurred. Explanation. Even though CAPM is elegant, it has several limitations that exam takers must remember. Single-factor world. Only market risk matters. Real assets face size, value, momentum, liquidity, and other risks. Homogeneous expectations. In reality, investors have different forecasts and information sets. Risk-free borrowing or lending at the same rate. Most firms cannot borrow at the treasury rate. Static one-period model. Ignores multi-period investment horizons and changing betas. Market portfolio is unobservable. The true all-assets market cannot be fully measured. Proxies such as S&P 500 are imperfect. Empirical anomalies. Studies find that low beta stocks earn higher returns than CAPM predicts. The low beta anomaly and high beta stocks earn less. Critical empirical criticisms. The betas are unstable finding. Betas estimated over a past window often mispredict future betas. Size and value effects, FAMA French. Small cap and high book-to-market firms earn a premium unexplained by market beta. Alternative models, exams often ask you to name them. FAMA French three-factor model adds SMB, small minus big, and HML, high minus low, factors to capture size and value risk. Carhart four-factor model adds a momentum factor, WML, to the FAMA French three factors. Arbitrage pricing theory, a PT, suggests multiple systematic factors without specifying which ones. When answering exam questions, list the key assumptions, why they are unrealistic, and note that the multi-factor models are designed to address these shortcomings. Q1 Conceptual 5 points. List the three core assumptions of the CAPM that are most often violated in practice and explain the impact of each violation on the model's predictions. Answer 1. 1. Existence of a risk-free borrowing lending rate. In reality, firms borrow at higher rates, causing the SML to be steeper for high beta assets. 2. Single period horizon. Investors plan over multiple years, so beta may change and expected returns deviate. 3. Homogeneous expectations. Differing forecasts mean the market portfolio is not truly mean variance efficient, leading to mispriced securities. Q2 Computational 10 points. Given the following monthly returns for StockX and the market index, compute StockX's beta and its expected annual return using CAPM risk-free rate equals 2% annual, approximately 0.166% monthly. Expected market return equals 8% annual, approximately 0.667% monthly. Returns in percent. Month 1, StockX equals 4, market equals 3. Month 2, StockX equals 6, market equals 5. Month 3, StockX equals 2, market equals 2. Month 4, StockX equals 5, market equals 4. Month 5, StockX equals 3, market equals 3. Answer 2, compute average StockX equals 4%. Average market equals 3.4%. Calculate covariance equals 1.5. Variance of market equals 1.0 using sample formulas. Beta equals 1.5 divided by 1.0 equals 1.5. Monthly market risk premium equals 0.667% minus 0.166% equals 0.501%. Expected monthly return equals 0.166% plus 1.5 times 0.501% equals 0.916%. Annualize approximately 0.916% times 12 equals 11.0%. Q3 Interpretation 5 points. A portfolio has an alpha of -2% per year. What does this tell an investor about the portfolio's performance relative to its systematic risk? Answer 3. The portfolio earned 2% less than the return predicted by CAPM given its beta. The manager underperformed after adjusting for market risk, indicating either